Hello and welcome to a brand new episode of ET Markets AIF Talk, a show where we discuss the opportunities as well as strategies deployed by the fund manager in the popular space of ultra HNI investing. Well, my name is Abhisar Jain, and today we have with us a very special guest, Abhisar Jain, who is a fund manager at Monarch AIF, who is managing around about 300 crores in AUM. Welcome to the show, Abhisar.
Thank you, Kshitij, and nice to be here.
Thank you so much for being part of this segment, Abhisar. Now, let me just quickly come to the point. What is your investment strategy for the MNCL Capital Compounders Fund, Series 1?
Yeah, so Kshitij, see, in our long-only Cat3 equity fund, we run a very concentrated strategy, which is always to bet on less than 20 companies. So it becomes very important that we select these companies very carefully. And we have a 4 to 5 step process in doing that. What we start with is that we want the compounding to be visible in the cash flow statement, because P&L in some sense is often managed or can be misleading, but the cash flow statement can reveal a lot of right data. So we look for cash flow compounding over long periods of time. Then we also look for management quality and accounting quality to be top notch, which we judge through our proprietary AIQCG filter as a starting point. We obviously then have to kind of go and probe those points a little bit harder, but we do have a quantitative filter called as AIQCG to judge the management quality and accounting quality, given that the amount of data that we do get these days, easily through a lot of databases, we have used that to our advantage. Now, going ahead, we also want that the companies that we are selecting should have some leadership traits in any of the product or services that they are into. They should have a decent long enough track record so that we can judge how the competitive intensity or competitive edge of the company has got stronger or weaker over time. And after doing that, we try and see that the growth visibility for the next 3 years, 5 years, or even for longer term, it's hard to judge longer term these days because of the disruptions, but we do try and judge the runway of growth for 3 year, 5 year, 10 year, and then take a view on the earnings growth of the company and the return on capital, whether it is going to improve versus past. So ideally, we need companies which are having a decent level of ROC and they're trying to improve upon it. So they are in that phase where they are strengthening their moats. And last but not the least, Kshitij is also entering valuations, which we give a lot of importance to. We don't, come at very good quality companies at any price. So we don't believe in buying at a good quality at any price. We want to buy a decent, fair quality, good quality, but also at a reasonable price. So this is in a nutshell is our strategy, which we have implemented across both our funds, and that's how we go about selecting the 20 stocks.
Right. In fact, you did touch upon the proprietary model which you have, that is AIQCG. Now, please share more details on that particular model and or that particular score, in fact, and how do you sort of weed out these suspects, from the focus list that you have?
Sure. Kshitij, so see, let me also be candid enough to say that there is no foolproof method always to weed out all the suspects that there can be. Okay, but what we do is we try and get the probabilities in our favor of being able to identify them. Now, what this the AIQCG does is it's a basically a filter, which is or a scoring mechanism. It gives a score to every company out of 100 based on 14 parameters. These 14 parameters are basically financial parameters, which are compiled based on the annual report data of last 7 years. So suppose you are a Reliance, suppose you are an Infosys, I will have a AIQCG score for you based on these 14 parameters from your annual report data of last 7 years. And an annual report, we look at a lot of data which is in schedule. So it's not just the P&L balance sheet cash flow. There's a lot of schedules there. So just to give you some examples out of those 14 parameters will be the volatility in the depreciation rate, volatility in the other income, how much it is, volatility in the miscellaneous expenses having an impact on, the EBITDA, the bad debts write-off, which the company keeps doing, the promoter compensation, which keeps changing, and the things, so on and so forth. Now, what will happen is that we will get a AIQCG score for every year. We will compile that score over 5-7 years. And then generally what our back testing has shown is that the companies which are scoring below 65, there are some companies which will score out of 100, 55, 60, 65, generally have some or the other financial shenanigans which they are using, or which have little bit of suspect accounting quality. And the guys who are consistently at 70, 75, or even above 65 have been little bit better. Now, what happens is that when we get a suspect score, and we don't look at only 1 year score. So if I take a score of Infosys, I look at the score of 23, FY22, FY21, FY20, and consistently, if it is coming less, it will give me a starting point to probe the management. I will also know in which parameter is scoring less.
Yeah.
I will do my little bit of a ground check, and third-party checks. So this filter has worked well for us. It has also helped us, avoid some companies altogether, or when we have probed the management on those points, the management getting uncomfortable has told us that, look, we should not get carried away too much by the growth and the P&L, which is looking and getting excited. Yes. On some of the, core issues or on some of the harder questions, the management is getting uncomfortable. So this is one. It's quite interesting. It's the score is quite automated because of the databases. We get all of this data after annual reports are published, and every year we can calculate the score. So this is what AIQCG is all about.
Right. So it's basically making the job slightly more simpler, but then again, yes, you have to pick the winners by yourself. It's an assistance which helps you pick the right kind of stocks for the portfolio.
So in fact, the AIQCG stands for Accounting, Quality, and Corporate Governance. That's why it's AIQCG.
AIQCG. Right. Yeah. Now that we have you here, we cannot let you go without getting your call on the markets as well. We are actually trading near about record highs. What are your what are your views on the market at this point in time? I think we've actually outperformed most of the other global markets, especially in the year 2023. Nobody was thinking that we'll be inching closer to the record highs. Nifty Bank has already hit a record high. Your views on the market?
Yeah, so the market definitely has picked up quite strongly in the last 2 months, and a little bit unexpectedly also. I think it's taken many by surprise. But if you look, Kshitij, closely under the hood, so we have spent around last 20 months in about this range. So of course we hit 18,600 on Nifty in October 2021, right? True. And after that, a lot of global events happened. We went down to maybe 16, or then we are back to this level. Yeah. Now, in the interim, Kshitij, what is important to note is that our fundamentals have kept on getting stronger. So be it the tax collections on both direct or indirect mode, okay? Be it the reforms that have picked up on the PLI side, be it the recovery in the real estate cycle, which is now looking little structural, be it the bank's balance sheet. You said Bank Nifty is all-time high because the bank's balance sheets have just cleaned up like anything, okay? Yes. And now they're sustaining. So those things have kept the fundamentals stronger. One other factor additionally, which has worked in our market's favor in big time, is the sustenance of the domestic flows across this 20-month period when you were not making returns in the market, okay, from the index. Yes. The flows have remained very, very strong, and they have made up for all the weak FI flows. And it looks like, the domestic investors are taking a long-term bet on India. They're not trying to trade in and out. They're not getting bogged down by the FII negative flows whenever they show up. They're in fact ready to buy. So with this, I think, Kshitij, now what we feel is that the Indian market has grown into its valuation. 1.5, 2 years back, the valuations were very high when we last hit 18,600 versus today. And so from here on, we are not betting for a very big valuation re-rating, but what we feel is the market from FY23 to 26 period, if you look, either 2-year period or 3-year period, should be giving you a CAGR which is equal to earnings CAGR, because you have adjusted for the valuation. And the earnings CAGR is something which we are looking at a early teen, if not mid-teen. We could get a mid-teen also if the recovery in the global comes up and there is no big recession, etc. But we feel that the index is well poised. It may not give you fantastic returns or supernormal returns or very big re-rating, but it should give you the earnings CAGR.
Right.
From here.
In fact, the bottom line is that stay put in this market. The story is still, there to be explored for investors. In fact, we are getting, you're talking about domestic flows, we were getting around about 13,000 to 14,000 crores on a monthly basis from the SIP. So yes, indeed, a big number which actually compensated for any outflows that we have seen from the FI front. But the tide is slowly turning from the FI side as well. That's what the recent data shows. So that's definitely an encouraging sign. Now, you did talk about the macro factors which are, gaining momentum or actually are more positive for the India side. So what makes you positive on the India story?
See, Kshitij, I want to point this out on the India story. Okay, it has kept the commentators like us excited a lot, many more times also in the last 2 decades, and sometimes it has failed to live up to its expectations.
True,
Right?
true.
Our per capita GDP is still in that early $2,000 per capita. So now, but I think what makes us excited is the one key thing about the India's digital public infrastructure, which has
Right.
connected you, me, and every individual in India through creation of some of these key layers around our payments, around our identity, and around our data sharing. And these are on the interoperable rails, okay, and through which both digitally public goods and services can be distributed at scale, like we saw for COVID vaccine.
True.
Now, what this is doing, Kshitij, and which we are not realizing when we are seeing these UPI transactions at
Hmm.
massive scale, okay,
At massive
massive
scale, yeah.
scale on a monthly basis.
Hmm.
What is this doing is that this is bringing everybody, on the formal economy.
Hmm.
And when you come on a formal economy, what happens is that the tax leakages go out. So, like I said in my previous question comment, that the tax, kind of tax payments have improved materially, both indirect GST and direct.
Hmm.
Why is this happening is maybe because of this connection. And when the tax collection with government is more, then the government can reinvest that money into the creation of public infra, the real physical infra,
Hmm.
which hitherto was missing. We have always scribed about poor infra in India and not coming up to the global standards. But that finally could happen. So if I were to call out for, one of the key reasons is I think that this digital public infra will create a big feedback loop and it will provide the trigger of our per capita GDP to finally catapult. See, we always had the demography in our favor. We are a
Hmm.
young country, we'll remain a young country next 10, 20, 30 years also.
Hmm.
But we needed some trigger for that young country to take that leap. And
Yeah.
that I think in the last 8, 10 years of what the digital public infra has been created by Mr. Nilekani and others,
Hmm.
it's just
Hmm.
mind blowing and it continues to keep improving. There are new, platforms continuously coming up, like now
Yes.
ONDC and account aggregator is coming. These
Hmm.
things will keep getting more success in my view, and then we will have that per capita increase, and that makes us positive on the India story actually.
Absolutely, and spot on. In fact, Abhisar, any big sectoral trends which you're watching? Digital is one, I'm sure. Any other sectoral trends that you're watching there?
Yeah, so I think we are also getting very excited about this commodity corrections that we are now seeing globally. Okay.
Okay.
And with the global growth slowdown, the commodity corrections could further take place with China
Hmm.
reopening, etc. So I think we feel that those trends, if they strengthen further, could positively impact sectors like cement, chemicals, and pharma.
Hmm.
Some of them have been a little bit under pressure in the last 1.5 years and have seen valuation correction also.
Right.
Secondly, we are also very positive on the sustenance of recovery in the real estate sector. So
Okay.
all through the interest rate cycle, which started going up, you didn't see the real estate demand weakening. In fact, you saw news like real estate selling 7,000-8,000 crore of project in a day. Now the results have come for all real estate companies, which have come really well. The demand is good, the inventory is coming down. So I think the
Hmm.
real estate cycles are longer. And in fact, now we may see interest rates softening again,
Hmm.
in a quarter or two. So effectively, I think the real estate and the building material sector, which is ancillary to that, should
Hmm.
also do well. And lastly, BFSI space has done quite well. Of course, you said Bank Nifty is all-time high. But if you look at it from a valuation perspective, the earnings that kind of coming in, the book value growth which could come in, we believe that the BFSI space should still have legs to go. You have
Hmm.
to pick your right names who will give a lot of
Oh.
importance to asset quality and not see
Hmm.
the bad asset cycle like we last saw.
Yeah.
There will be a good amount of names there. And hence, these are the sectors, Kshitij, that we are liking, of course.
Absolutely. And most of these are related to the India story. So as and
Yeah.
when India story progresses, all these sectors should actually get the benefit out of it. Now, my next question is, in fact, very interesting one. And MNCL Capital Compounders has gone for a premature closure with good returns to the investor. Such incidents are not very common in the AIF platform space. But what was the secret mantra followed by Monarch?
So yeah, Kshitij, so see, we had gone for a pre-closure of one of our funds, which was our maiden fund,
Yeah.
and we closed it around 5 months before the actual scheduled ending of the term.
Okay.
So it was supposed to end in October, and we have chose to end it in May. We generated around 23.5% pre-tax CAGR in this 2 years, 7 months of operation.
Okay.
See, the mantra was not, something out of ordinary or something unique. We actually stick to our investment strategy, which was your first question. And we were very careful on the entry valuation, Kshitij. After, the company clearing all our parameters, we were not over the board in terms of paying top dollar for anything. So like, I mentioned also that the Indian market has seen a lot of time correction in last 20 months. We have spent time.
Yes.
So that thing worked in our favor, that our companies were not very heavily priced, and we could see the compounding in our portfolios through both earning CAGR as well as valuation re-rating. Because, the companies that we were selecting were having comfort on both those sides. We decided to pre-close to, prevent our investors from any shocks that could see in the global market, considering that the global scenario is a little bit up and down with a lot of bank problems which are happening and the recession in view, and 5 months were left for the closure. So we chose to, lock in the above 20% CAGR.
Great. Now, lastly, SEBI is in fact planning, or there has proposed various changes to bring transparency in AIFs. What are your views, and will it, or how will it impact your funds?
So, Kshitij, we like the proactiveness which SEBI is showing. Okay, and we believe that some of these changes could end up bringing a lot of confidence into the AIF industry, which is of course growing by leaps and bounds as we speak. But it could bring the confidence of the investors even more. So, just to quote a one or two, we really, liked one of the recent changes which SEBI has in fact implemented, wherein they have abolished the upfront commissions on the distribution-led AUM raise, which happens in AIF. And we were always in favor, and that's why, in fact, in our first both two funds, we had not raised any money through intermediaries or distributors. It was raised all through our direct channel and direct contacts. The upfront commissions were, I think, too high. Now the SEBI has abolished and made it a trail kind of a model only, just like it happens in, say, MF and PMS. Secondly, I think SEBI is also looking at reducing the compliance burden for the AIFs. Currently, the compliance burden is too cumbersome. So that will help in operations easing a bit for the AIF managers like us. And there are a host of others also. So per se, we see a lot of them have positives for the industry. And of course, for us also, we are a young player in this industry trying to make a good mark over time. So I think all these changes coming now should help all of us as stakeholders.
No, absolutely. In fact, we wish you all the very best on your future journeys as well. And fantastic closing on the first fund that with over 20% CAGR. I mean, that's fantastic. On that note, thank you so much for your time, Abhisar. And that's all for now. But do stay log on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time.
Thank you.